Our next speaker here today is Nick Esterline to talk about hospitality industry. Nick is the founder and managing principal of TGC Group, a fully integrated development, construction, and management firm focused on acquisition, syndication, and development of hotels and restaurants throughout the country. TGC currently operates 10 hotels under the Marriott, Hilton, La Quinta, and Woodspring Suites brand, say that 10 times fast, with an additional 3 hotels currently under development. Nick is primarily responsible for overseeing all capital transactions of the company, as well as overall corporate culture and strategy. Please join me in welcoming Nick.
All right, well, I got a very firm email from Kristen that said, we prefer you not talk about anything local and talk about national. And as I sat there for the last hour and a half and watched everybody talk about local, I realized this may be a bust. So you either teed me up for a bust or I followed instructions. Well, I'm going to go through a few statistical slides and then I'll talk about what we're seeing on the national scale. We do operate a few hotels here in Wichita, but most of what we do is out of state. We're in 7 states now with our assets, and so we've got a little bit wider look at what's going on. But I'll go through some stats here. So the hospitality industry, this is a 30-year chart looking at what in the hospitality industry we consider probably the most important statistic or metric for us, which is RevPAR, revenue per available room. And the hospitality industry gets a little bit of a bad rap of having pretty deep dives and pretty wide swings. But if you look at this chart, you'll see over the last 29 years, 23 of those years have had positive RevPAR growth. Now it may not have been 5 or 6% a year, which we all love, but anything north of the zero line is still growing, and the majority of the 23 years there had 2% or greater growth. And so if you look through that and think about a 30-year span, 23 out of the 29 is not a bad run for the hospitality industry. We've had a couple of major swing downs, and I'm going to go through what I think are the big things that hit the hospitality industry. And one of them certainly interest rates. When they swing, that's a very impactful thing to the borrowing side of the hotel industry. Hotel loans aren't necessarily easy to come by anyway because you've got a real estate component as well as a operating business component. So understanding how to borrow money in the hospitality industry is a little bit of a trick sometimes. So interest rates and the lending environment's big. Geopolitical is another major impact on the hospitality industry. And then, acts of just human folly, just sheer foolishness, which we'll talk about here in a minute. But in 2001, we all understand what took the economy and specifically the hospitality industry down. And you could say that was somewhat of a national hit and a national problem, but I actually think it was more geopolitical. That was a worldwide issue that occurred, in the United States, center stage, that slowed not only the United States down, but the world down in the hospitality industry. The next one that hit is just sheer foolishness. The lending crisis and the TARP and trying to find our way as a economy, but especially in the hospitality industry through the bank bailouts and the shutdown in the lending environment was a big deal. We actually had 3 projects under development at the time that the crash happened, and we shelved it. We couldn't raise equity on our projects, we couldn't find debt on the projects, and so we shelved 3 projects, and we were one of many, many people that literally just stopped in our tracks for about an 18-month period. Then, looking at 2020 and what's coming at us, there's a lot of people in the industry, and we've been to some conferences the last few weeks where people are talking about what's coming at us. And I'll go through some more slides and statistics, but to sum it all up right away, I think not much is going to happen. I think short of a national catastrophe or something wild happening during the election season, I think we're probably going to slow down a bit. I think we're going to dip below the zero line temporarily. And you'll see on the next slide what supply and demand is doing to that. But I think this is going to be a little bit of a soft cushion down landing into 2020, 21, and then we'll start to see a little pickup again. But going on to the next slide, supply demand right now is probably going to be one of the things that holds us down for a little bit. Right now, they're both sitting right on top of each other at about 2%. Generally, when you'll see the activity in the building market for hospitality start taking off again, it's triggered by at least about 2-point delta between supply and demand. As that starts to hit the street, people will start building again. A lot of people you'll see in the neutral time where supply and demand are sitting on top of each other, or maybe where they invert a little bit, you'll start seeing a pickup in the entitlements and design, and then people will sit on plans until they see that gap widen again, and then they'll start construction. But for right now, they're sitting right on top of each other. I think that that's going to continue for the next 18 to 24 months. But I think the other aspect of supply demand that everybody needs to look at and consider is we're past a macro look. So you can't just look at the United States or the economy as a whole and say, we're in a good hotel cycle and we should be building right now. I think now's the time to dial in and start looking on micro level, because there are still markets out there in the United States where demand is outpacing supply significantly. Now, that can be triggered by tough entitlements and high barriers to entry. And so demand is kept a little artificially high for those things. But there's also some markets out there where they were so underbuilt for so long that the hotel supply has not caught up with the demand yet, and a lot of that's driven by the corporate environment growing, and the Googles, the Amazons, all these companies that are expanding out, especially in the Midwest, and adding campuses. They're pushing bodies and jobs into these economies at a faster pace than what the hospitality industry has been able to absorb. And so looking at the building opportunities and supply demand on a micro level is pretty critical right now. But nationally, they're sitting right on top of each other. Another big factor when we look at the industry is average daily rate. Generally, you've got three metrics. You've got occupancy, you've got average daily rate, and you've got revenue per available room, which is essentially a blend of the two. But you rarely will see occupancy and average daily rate growing at the same time. For the last 8-9 years, we've seen that, and that's generated quite a building boom, as we've discussed. But eventually, they'll start to tip. And the first one that generally tips is occupancy, mostly because that's controlled by the economy and the sector and the consumer. Average daily rate, that's driven mostly by the decision of the operators. And we tend to get greedy and hold on as long as we can before we start dropping that rate. But you're starting to see that now. And although it's still positive and it's still above water, it is slowing, and it's slowing at a very accelerated pace nationally. Again, I think you've got some markets where you're seeing 2, 3, 4% ADR growth still, but it's on a very, very, very select basis. And you got to dig in and find out, why is it growing at 2, 3, 4%? And generally what we're seeing when we're underwriting deals is it's generally driven by a specific event. So, for example, we were looking at a deal in Minneapolis, looking at the STAR reports, trying to understand why their growth was what it was over the last 18 to 24 months. Super Bowl. So, the 6 months prior to Super Bowl and the 3 months after the Super Bowl, the amount of people that are coming into that market to service the Super Bowl, to set it up, to break it down, to function, and obviously all the spectators coming in gave that market a huge pop on rate. that was completely artificial. And so again, you got to look at these markets as case by case and dig into the micros, but this is what we're doing nationally. So looking at where we're at now and where I think, the 2020 forecast, and this data is coming from Smith Travel Reports. 2019, as we've discussed, supply and demand are right on top of each other. A little bit of occupancy growth this year, 0.2% is really nothing to write home about. From my perspective, if it's not 1.5 or greater, we're actually slowing down and going backwards. Average daily rate grew a little bit, RevPAR grew. 2020 forecast, and again, this is what the lodging industry and Smith Travel is projecting. And by the way, they projected 2019 spot on the nose. We went back and looked at our notes from the 2018 conferences and STARS report and forecast for 19, and they hit it spot on. And I think they're probably going to dial it again for 2020. But again, you're seeing a little bit of supply-demand inversion there. Occupancy is clearly dropping, and so I think they may even be a little bit light on what they're projecting in terms of 0.3 drop in occupancy. Average daily rate is going to continue a little bit, and most of that's going to be, again, because hoteliers are greedy and we're going to hold on as long as we can, and resulting in a little bit of RevPAR growth. 1 to 1.5% is not really keeping up, and so again, that's considered in our industry nationally, that's considered flat. A lot of people will think that the flat market is a bad time for the hotel industry. It's going to crash. There's problems. It's a normal course of business, and so we can't see 3, 4, 5% every single year. Eventually, we're going to have some flat times. So, talking about pipeline for a little bit, what's under construction. So right now we're in 2019, we've got 207,000 rooms under construction currently. That's obviously up quite a bit from 2018. With the amount of time it takes to design, build, and entitle for hotels, there's quite a lag from the planning, final planning, and then into construction phase. And so, a lot of what's going into the ground right now was in planning and in progress in 2018, and it's just now hitting construction phase. As you can see, we're only about 4,000 keys off of the 2007, 2008 pace before everything slowed down and shut down. That's not overly worrisome from the standpoint of supply coming into the market because the demand jumps so hard. But as you can see in final planning and planning nationally, there's quite a backlog that's coming. Most of this backlog is in what's considered the upper mid-scale to luxury section. That's where a lot of the rates been driven, a lot of occupancy has been driven. In the economy sector, so like what we do, one of our brands is Woodspring Suites. They've got the least amount of hotel rooms under construction nationally, leading into the mid-scale segment of extended stay. So think Town Place Suites, Home 2, Staybridge Suites, Residence Inns. There's a decent amount of those under construction, but comparatively speaking with what's in the pipeline, most of it's hitting the upper mid-scale and luxury sectors. And so that's where you're going to see a lot of projects stall out, I think, over the next 2 or 3 years. So here's a look at Wichita versus the United States, and there's a caveat to this. The Wichita statistics include everything from the Roadway Motel on West Kellogg all the way through the Autograph Collection. So the Ambassador downtown. The United States statistics do the same thing, but when we look at our Wichita numbers, and as I was going through the STAR reports on this, if you look at the weighting of what I would call the lower tier, less desirable hotels, they're more heavily weighted against Wichita's comp set than nationally. And so there's a skew here in the numbers, and I'll talk through that here in a second. But nationally, the United States is sitting at about 67.6% occupancy with $132 average rate and RevPAR of $90. Again, everything from Woodspring Suites, Comfort Inn Suites up to Ritz-Carlton's is the blend that's driving that. So the year-over-year change is 1.2% on RevPAR. Wichita historically has trailed the national average. Matter of fact, in the last 8 years of data that I was looking at, I didn't see a single year that we were within 5% of the national average. Wichita just historically has had a lag on the national average. Doesn't mean there's not still room to build. Doesn't mean that there's not still opportunities within the marketplace over the last several years, but it has historically lagged, and a lot of that has to do with the supply that we have funnelling into this data point. But as you can see, we're trending exactly with the national average in terms of our growth, which is a good thing. And I think as we see newer product come into the market, we've got a couple hotels here in this market. We've got one we're getting ready to start downtown, the Hilton Home 2 at the Atlanta Catalyst site. There's pockets within the market that we think rate opportunity is still there if the right product is delivered. But to be determined, I guess. We'll see if we're right or wrong, but I think we're right. So switching over to kind of just a local, national comparison on supply demand. Again, a bit of a caveat on 2018, when you look at that demand number, I wanted to put this in here to accentuate NCAA tournament, the ice skating competitions that came through town, bowling was a big impact on this. Those are the kind of things that swing this demand. When I stripped that out and looked at what Wichita's demand actually was, it's set right at 2%. And so this is an example of how somebody could look at data and go, that's a market we ought to be building in, or I've got a piece of dirt that needs a hotel, I'm going to go find a hotel developer and show them these stats and try to sell on the site. There's more to this story. There were some very, very specific circumstances that drove that demand for 2018. I think as I looked at 2019's year-to-date numbers, we're sitting right on top of 2%. So supply demand is completely neutral right now. So I'll hit a few summary points here, and then I want to talk lastly about what we're seeing on valuations and lending in the national scope. So, globally or nationally, the hotel industry is still viable. There's still opportunities out there. The micro has to be dialed in, and you have to pay really close attention to it. It's no longer just the macro look of, is this a booming hotel cycle? Let's go build hotels. Occupancy is going to continue to slowly decline, mostly at the hands of supply pressures, but I don't think we're going to see a massive crash on occupancy. I think we're going to see a gentle landing into the next 2 to 2.5 years, and then we'll start cycling up again. Average daily rate, same thing, although it's positive, it's going to slow at the hands of guys like us trying to hold on to rate as long as we can before we start to see our occupancy not just do this, but do this. We'll adjust our rate and throttle up, and we'll level off on occupancy again, and that's kind of the metric we look at. RevPAR, same thing. It's going to grow, but it's going to grow slow, and for the foreseeable future, any growth we see in RevPAR is going to be purely ADR driven. Supply is expected to exceed the demand. We've talked about that. Again, I don't think it's going to be crazy. I think one of the things that the lending community has done nationally really well this time around is they've quit lending money to doctors, lawyers, and barbers to build hotels. It's kind of the old saying, when your barber starts talking about buying gold, sell all of yours. And when your attorney and all his buddies tell you that they've just built their first hotel, sell them all your shit. And wait until they give it back to the bank. But I think the bankers have done a really good job. Well, it's true. It's true.
The doctors.
Yeah. Well, the doctors too. Yeah, they're partners with most of the lawyers that build hotels. Where's Mert? I'm sorry. I know he's in here somewhere. Lost my train of thought there. But, anyway, so I think the lenders have done a really good job controlling that flow of money to inexperienced developers, owners, and operators of hotels, and that's been a very good thing for this cycle. So one thing I haven't talked about yet, and I'll touch briefly, is margins in the hotel space are getting tighter right now, and most of that is attributed to the payroll pressures. We're seeing minimum wage increases, unemployment, people's demands for benefits are driving this, and so the lazy operators are going to have some problems, and they're going to suffer because they aren't managing that culture / benefits / wage piece / room rules. There's a whole kind of algorithm there that needs to be managed in order to keep margins headed the right direction for the operators. The people that are investing in their culture and their people, and they're investing in responsible benefit packages for their staffing, are going to be successful. And so that's something we're watching pretty closely. And then I touched on this, those are the big pressures: interest rates, geopolitical, and human folly. I think probably the biggest risk for us right now in all of this is kind of the human folly piece, and what happens through the election cycle, and what happens with our trade wars. We just got hit with, was it the Georgia project, Cameron, that we got hit with an unexpected tariff? I think it was $7,000 or $8,000 to get our stuff off the boat. And you kind of look at that and you go, well, that wasn't in the plan. And they really don't care. If you want your stuff from China, that's what you're going to pay, and that's where most of the FF&E is coming from. So, that's something that we're trying to pay attention to. We have zero control over, and so that falls into the human foolishness category, in my opinion. And then lastly, I'll just touch, in terms of the investment market for hotels, we're seeing a ton of liquidity out there still for high cash flowing and producing hotels in good markets. And so we just built a hotel in Fort Worth, opened it in December of 18, I think is when we opened that hotel, and we get calls regularly, would you sell that? The answer is yes. The problem is they want to buy at a slight premium to construction costs, but they're not looking at buying on a stabilized pro forma. But there is a ton of liquidity out there chasing deals right now in the hotel space, primarily with strong flags, Marriott, Hilton, Choice, looking to start to get a little attention as well. So valuations are staying relatively strong. The lending environment is still pretty good. We're actually moving some of our assets to the secondary market right now. We just completed a refinance with Goldman Sachs on a 4.5-year-old hotel, and we were able to complete a cash-out refinance. Still stayed under 65% loan to value. We locked our rate at about 4.25% for 10 years and took it to a non-recourse level. And as soon as we got to the closing table, closed that deal, I got a call the very next day from our closing gal in New York, and she said, how many more can we do with you by the end of the year? And so they're pushing money out the door right now. They're trying to fill their buckets. And I think that if you've got clients or if you guys have hotels that you're interested in refinancing, right now is a great time, especially to get to the secondaries where they'll let you pull out some cash and prepare yourself for the downturn. And that's what we're doing. We pull the cash out not to necessarily distribute all of it. We're creating war chests, and we're setting money aside and waiting for that slowdown to happen so that as we ride through that cycle, we aren't completely freaked out on the pressures that some of the operators are going to experience. So that's what I've got. Any questions?
I have a question about Airbnb and how that's affecting your industry.
Mm-hmm.
Have you seen that at all? Or?
Yeah, in the segments that we operate in, which is limited service and extended stay, we don't see that pressure. Maybe every once in a while somebody will make that decision to go an Airbnb route over our product, but it's not been near what people thought it was going to be. There's definitely a defined market for the Airbnb. There's definitely an opportunity there for people that own properties and move into those pools. But it's not hit the hospitality sector the way people expected it to. Yeah.
What about opportunity zones and opportunity funds? How does that play into the market?
Yeah, great questions. We just completed one. The Hilton Home 2 in downtown Wichita that we're gonna build is in an opportunity zone. We put it into a fund. It's actually pretty interesting. The hotel business, it's like a 747 getting off the ground. You need a long runway, you need lots of time to get up to 30,000 feet, and then you stabilize, and it's really hard to take it down from there if you get it to 30,000 feet. So for people that understand hotel investing, having an opportunity zone on top of the opportunity to do a hotel, pun intended there, is actually a perfect marriage. So we're seeing people that have opportunity zone cash go, where's the next hotel deal, and is it in a zone? The other kind of double benefit that we've got there is with the new tax laws the last couple of years on accelerated depreciation for the FF&E and some of your other softs through the deal. That's 100% write-off the day we open. And then a cost seg on top of that squeezes our 39 down to about 24 years. And then on top of that, we've got the opportunity zone benefit. I mean, there's lots of layers right there that the savvy investors are really excited about. Is that it? All right, thank you.